If I were you, I would be selling these two stocks immediately, not next week, not next month, right now. And if you own these stocks, you need to understand why the numbers are screaming danger. I'm Kevin O'Leary. You know me from Shark Tank. You've seen me on CNBC's Squawk Box analyzing markets every single day. I've been doing this for 40 years. I built a software company from scratch and sold it for $4.2 billion. I understand valuations better than 99% of people on Wall Street. And these two stocks, they're not just overpriced. They're financial disasters waiting to happen. Before I reveal which stocks I'm selling, I need you to do something for me right now. Hit that subscribe button, smash it. Why? Because this channel is about protecting your wealth, making disciplined investment decisions, and never letting emotion override data. We're building an army of smart investors who sell when the numbers tell them to sell, not when everyone else finally figures it out. Subscribe now. Now, let me set the stage for what's happening in the market right now. We're in one of the most dangerous periods I've seen in my 40-year career. Valuations are stretched. The S&P 500 is trading 63% above its long-term trend. The Shiller CAPE ratio is sitting at 40, well above its historical median of 16. That's not normal. That's bubble territory. And here's what most investors don't understand. When valuations get this extreme, it's not about whether a correction happens. It's about when and how severe. I saw this in 2000. I watched the dot-com bubble destroy people who swore their favorite tech stocks would never go down. I saw it in 2008 when real estate investors believed property values always went up. They were wrong. Brutally wrong. The market doesn't care about your feelings. It doesn't care that you love a company's products. It doesn't care that you believe in the CEO's vision. The market cares about earnings, cash flow, valuation multiples. And when those numbers stop making sense, the market corrects violently. Right now, there are stocks trading at valuations that have no basis in reality. Stocks where the price-to-earnings ratios are so divorced from fundamentals that holding them is pure speculation, not investing, gambling. And I don't gamble with my money. I invest based on cold, hard data. That's why I'm selling two specific stocks, not because I think they're bad companies, not because I don't believe in their products, but because the numbers don't work, the valuations don't make sense, and the risk reward is terrible. When I was building my education software company, we had this one project that everyone loved. The technology was exciting, the team was passionate, but when I looked at the numbers, it was clear this project was going to lose money. I killed it. I didn't care how much people loved it. The numbers don't lie. That's the mentality you need right now. Because if you're holding on to stocks, just because you like them, just because they've gone up in the past, just because selling feels like admitting defeat, you're going to get crushed. Smart investors sell when valuations become irrational. Broke investors hold all the way down and tell themselves it's going to come back. Stock number one, Tesla. The first stock I'm selling immediately is Tesla. And before the Tesla fanboys start losing their minds, let me be absolutely clear. This is not about whether Tesla makes good electric vehicles. This is not about whether Elon Musk is a genius. This is about valuation, pure and simple. Tesla's current price-to-earnings ratio is 322. Let me say that again, 322 times earnings. Do you understand what that means? For every dollar of profit Tesla generates, you're paying $322 for the stock. That's not investing, that's insanity. Let me put this in perspective. General Motors has a PE ratio of 8. Ford has a PE of 10. Even traditional auto manufacturers that everyone claims are dying have PE ratios between 7 and 12. But Tesla, 322. Now, Tesla bulls will tell you, Kevin, you don't understand. Tesla isn't a car company. It's a technology company. It's an AI company. It's a robotics company. That's garbage. That's what broke people tell themselves to justify holding overvalued stocks. Let's look at the actual numbers. Tesla's P/E ratio has increased 68% compared to its 12-month average of 192. Think about that. The stock was already expensive at a P/E of 192. Now it's at 322. The stock is trading 31% higher than its 6-year historical average of 224, and that 6-year average already included the massive bubble run-up. Here's what's really concerning. Tesla's trailing 12-month earnings per share is $1.50. The stock price is $483. That gives you a PE of 322. But if you look at intrinsic value calculations using discounted cash flow analysis, Tesla's fair value is around $57 per share. That means the stock is currently overvalued by 88%. 88%. Now, some analysts will point to forward PE ratios and say, well, if you look at next year's earnings estimates, the forward PE is only 172. Only 172, as if that's cheap. But here's the problem with forward PE ratios on Tesla. They assume everything goes perfectly. They assume autonomous driving launches on schedule. They assume the cybercab becomes a massive revenue generator. They assume the Optimus robot achieves mass production. They assume no competition emerges. They assume no regulatory hurdles. That's a lot of assumptions. And when a stock is priced for perfection, any disappointment is catastrophic. I remember people telling me in 2000 that Amazon was going to dominate e-commerce. They were right. Amazon did dominate. But you know what happened to Amazon stock in the crash? It lost 94% of its value, from $113 to $6, because the valuation was ridiculous. Tesla might be a great company, but at a P/E of 322, the stock is priced as if nothing can go wrong for the next decade. That's not how investing works. Consumer cyclical stocks are now trading at a 19% premium to historical valuations. That's one of the highest premiums we've ever seen in that sector. And Tesla is the second largest stock by market cap in consumer cyclicals. It's a massive driver of that overvaluation. When I look at Tesla, I see a stock that's gone from a market cap of under $100 billion to over $1.5 trillion. That's an incredible run, but that run is over. The easy money has been made. What's left is massive downside risk. The market is giving Tesla credit for future businesses that don't exist yet, robo-taxis that aren't operating, humanoid robots that aren't in mass production, energy storage businesses that are promising but not game-changing. And here's the most important thing. When you're paying 322 times earnings, you're not buying based on fundamentals. You're buying based on hope, based on narrative, based on the greater fool theory that someone will pay you more than you paid. I don't invest that way, and you shouldn't either. Tesla PE ratio of 322, up 68% from 12-month average of 192, overvalued by 88% based on DCF analysis, intrinsic value $57 versus current price $483. Stock number 2, Lululemon. The second stock I'm selling immediately is Lululemon, and this one is different from Tesla. Tesla is overvalued based on extreme multiples. Lululemon is a deteriorating business disguised as a premium brand. Here are the numbers. Lululemon peaked at over $423 per share in January 2025. As of now, the stock sits closer to $190. That's a decline of 55% from the highs. Now, some investors look at that and think, Kevin, that's a buying opportunity. The stock is down. It must be cheap. Wrong. Dead wrong. When a stock declines 55%, you don't ask whether it's cheap. You ask why it declined, because stocks don't cut in half for no reason. Here's what's happening at Lululemon. Same-store sales are falling. Revenue growth is slowing. The company is facing a fundamental problem. The athleisure trend that made Lululemon a powerhouse is changing. For years, Lululemon dominated because they created a category. Premium athletic wear that you could wear to the gym, to the grocery store, to lunch. They charged $100 for yoga pants, and people lined up to buy them. But now, the competitive landscape has changed dramatically. Nike is aggressive in the space. Under Armour is fighting for market share. Fast fashion brands are producing similar products at a fraction of the price, and consumers are pinched. That last point is critical. Consumers are facing inflation. They're facing higher interest rates. They're facing economic uncertainty. And when consumers get pinched, discretionary spending gets cut. Nobody needs $100 yoga pants. Lululemon's brand power is eroding. Market trends are shifting against them, and their growth story is over. When I look at Lululemon's financials, I see a company that's running out of runway. They expanded aggressively. They opened new stores. They invested in marketing. But the return on that investment is declining. Same-store sales are the most important metric for retail companies because opening new stores can mask underlying problems. But same-store sales show you whether existing locations are growing or shrinking. And Lululemon's same-store sales are falling. That tells me consumers are choosing alternatives. They're buying less frequently. They're trading down to cheaper options. The premium positioning that Lululemon built is losing its power. Now, Lululemon bulls will say, Kevin, the brand is still strong. They have a loyal customer base. They're expanding internationally. But that's not what the numbers show. The numbers show a company in structural decline. Not temporary weakness, structural decline. And here's the thing about retail stocks. When they turn fast because retail is brutally competitive. There's no moat, no switching costs. If a consumer can get similar quality elsewhere for less money, they will. I've seen this pattern before. Premium brands that lose their pricing power. Companies that overexpanded and now can't generate returns on their store base. Retailers that face changing consumer preferences and can't adapt fast enough. Lululemon is checking all those boxes. The stock might bounce, it might have short-term rallies, but the long-term trajectory is down because the fundamentals are deteriorating, and you don't hold deteriorating businesses hoping they turn around. You sell them and redeploy that capital into companies with growing fundamentals. Lululemon declined from 423 to 190, 55% drop, same-store sales falling, revenue growth slowing, facing intense competition in saturated athleisure market. Now let me reinforce why I'm selling these two stocks and why the discipline to sell matters more than ever. First, understand that selling is harder than buying. Psychologically, it's brutal. Selling feels like admitting you were wrong. Selling feels like giving up. Selling feels like losing. But smart investors don't think that way. Smart investors understand that selling at the right time is just as important as buying at the right time, maybe more important. When I look at Tesla, I see a stock where the valuation has completely disconnected from the business fundamentals. Yes, Tesla is growing. Yes, Tesla is innovative. Yes, Tesla has loyal customers. None of that matters if you're paying 322 times earnings. Because here's what happens when valuations get this extreme. Any disappointment, any miss, any unexpected problem causes massive sell-offs. The stock doesn't decline 5 or 10%, it declines 30 or 40%. Because when you're priced for perfection, imperfection is catastrophic. Look at what happened to NVIDIA recently. NVIDIA is actually delivering incredible results. Revenue up 62% year over year, earnings growing massively. But the stock has been under pressure. Why? Because even with great results, the expectations were so high that anything less than perfection disappoints. Tesla is in an even more dangerous position because Tesla isn't delivering NVIDIA-level growth. Tesla's automotive business is actually declining in some quarters. Deliveries are under pressure, competition from Chinese EV makers is intensifying, and the stock is priced as if none of that matters. That's not investing. That's hoping, and I don't hope with my money. Now, with Lululemon, the problem is different, but just as serious. This isn't about extreme valuation multiples. This is about deteriorating business fundamentals. When a premium brand loses its pricing power, that's a death sentence because premium brands live and die on their ability to charge more. If Lululemon can't justify premium prices, they become just another athletic wear company competing on price. And competing on price in retail is a race to the bottom. I've watched companies try to maintain premium positioning after they lose consumer loyalty. It never works. They cut prices to maintain volume. Margins compress. Profitability declines, and the stock follows. Same-store sales are declining. That's not a temporary problem. That's a signal that something fundamental has changed. Consumers are voting with their wallets, and they're saying Lululemon isn't worth the premium anymore. When I was running my companies, I always focused on the numbers, not the narrative, not the story, the numbers. Because numbers don't lie. Stories can lie, narratives can lie, but numbers tell you exactly what's happening. Tesla's numbers say the valuation is irrational. Lululemon's numbers say the business is deteriorating. Those are facts, not opinions. And here's what separates smart investors from broke investors. Smart investors act on facts. They sell when the numbers tell them to sell. Broke investors hold because selling feels bad. They rationalize, they make excuses, they wait for the stock to come back. But sometimes stocks don't come back. Sometimes they keep going down. And by the time broke investors finally capitulate and sell, they've lost 60, 70, 80%. That's not going to be you because you're going to have discipline. You're going to sell when valuations become irrational, even if the stock has been good to you in the past. You're going to sell when business fundamentals deteriorate, even if you love the brand. That's what protects your wealth. Discipline, data, and the willingness to act when the numbers tell you to act. Let me summarize what we've covered today. Two stocks I'm selling immediately. First, Tesla. Price to earnings ratio of 322, trading 88% above intrinsic value. Priced for a perfect future that may never materialize. Automotive business under pressure from Chinese competition. Stock driven by narrative, not fundamentals. Massive downside risk with limited upside. Second, Lululemon declined 55% from $423 to $190. Same-store sales falling. Revenue growth slowing. Premium brand losing pricing power. Facing intense competition in saturated market. Structural decline, not temporary weakness. This is about discipline. This is about making decisions based on data, not emotion. This is about understanding that sometimes the hardest decision is the right decision. Selling doesn't mean you made a mistake buying. Markets change, valuations change, business fundamentals change. Smart investors adapt. They don't hold stocks out of pride or stubbornness. They hold stocks that make sense based on current valuations and current fundamentals. Tesla doesn't make sense at a P/E of 322. There's no scenario where paying 322 times earnings is prudent. None. You're not investing at that price. You're speculating that someone will pay you even more. Lululemon doesn't make sense when same-store sales are declining and the competitive environment is intensifying. Premium brands that lose their premium positioning rarely recover. If you own these stocks, you need to seriously evaluate whether the risk-reward makes sense, because right now, both of these stocks have massive downside risk and limited upside. The market is going to correct. I don't know when. Nobody does. But when you're trading 63% above long-term trends with a Shiller Cape of 40, history says a correction is coming. And when that correction happens, the stocks that are most overvalued get hit the hardest. Tesla, trading at 322 times earnings, is going to get demolished. Lululemon, already down 55% with deteriorating fundamentals, is going to keep declining. Don't be the person holding through that pain. Be the person who sold when the numbers told them to sell. If you found this valuable, I need you to take action right now. Smash that like button. This information could save someone from catastrophic losses. They need to hear this message. Share this video with your friends and family. If they own Tesla or Lululemon, they need to understand what the numbers are saying. Don't let the people you care about hold overvalued stocks out of ignorance. Leave a comment below. Tell me what you think. Tell me if you own these stocks. Tell me if you're going to sell or if you're going to hold. I want to know. I read these comments. And consider becoming a member of this channel for exclusive content. We're building a community of serious investors who make decisions based on cold, hard data, who understand that protecting your wealth means selling when everyone else is still buying. This isn't about getting rich quick. This is about not losing everything when the market corrects. This is about having the discipline to sell overvalued stocks before they crater. We're building an army of smart investors who understand that the numbers don't lie, who understand that valuation matters, who understand that sometimes the best investment decision is selling. That's what this community is about. So hit subscribe, join us, and let's protect our wealth together. Stay smart, stay disciplined. And remember, selling isn't losing. Selling is protecting your wealth. And in this market, protection is more important than speculation. The numbers don't lie. Tesla at a PE of 322 is a disaster waiting to happen. Lululemon with falling same-store sales is a deteriorating business. Sell them, protect your wealth, and live the life you deserve.